Let's talk about a financial powerhouse, Singapore, and how it manages its massive wealth. Singapore's foreign reserves are among the world's largest relative to its GDP. In fact, according to GIC, Singapore's official sovereign wealth fund, they rank third highest globally. But you might have noticed that these reserves have dipped recently. So what's going on? Well, it all started with the COVID-19 pandemic. The pandemic hit the global economy hard, and Singapore was no exception. To stabilise the economy and support businesses and individuals, the Singaporean government had no choice but to dip into its reserves. During the pandemic, economic activities were severely disrupted, leading to a sharp contraction in Singapore's GDP. The government had to act fast. They rolled out various fiscal stimulus measures to provide immediate relief to those affected by the crisis. One of the key strategies was to tap into the nation's substantial foreign reserves. So, how much foreign reserves does Singapore really have? Let's break it down. Singapore's reserves are managed by three key entities: the Monetary Authority of Singapore, MAS, GIC Private Limited, and Temasek Holdings. The Monetary Authority of Singapore, MAS, is the central bank and financial regulatory authority. It manages the official foreign reserves to ensure monetary stability and safeguard against economic shocks. Think of MAS as the first line of defence, always ready to step in during turbulent times. Then there's GIC Private Limited. Established in 1981, GIC is tasked with managing Singapore's foreign investments. Its mission is to secure a good long-term return on the nation's reserves. GIC invests in a diverse range of assets globally, including equities, bonds, real estate, and private equity. This diversification helps spread risk and capitalise on various market opportunities. Finally, we have Temasek Holdings. Unlike GIC, Temasek operates more like an investment company. Established in 1974, it owns and manages a portfolio of investments across various sectors. Temasek focuses on delivering sustainable returns over the long term. It has stakes in many major Singaporean companies and strategic investments worldwide. Together, MAS, GIC and Temasek form the backbone of Singapore's financial management. They ensure the country remains financially robust and can weather economic storms. Now, why does Singapore maintain such large reserves? The answer lies in the country's unique position as a small, open economy highly dependent on international trade. Large reserves provide a cushion against external shocks, such as sudden capital outflows or global financial crises. They also instill confidence among international investors and credit rating agencies, contributing to Singapore's economic stability. But managing these reserves isn't just about safeguarding wealth, it's also about growing it. By investing wisely through GIC and Temasek, Singapore ensures that its reserves generate returns that can be used for future generations. This forward-thinking approach is key to Singapore's economic strategy. So, when the COVID-19 pandemic struck, Singapore was prepared. The government's decision to use the reserves was strategic and necessary. It allowed the country to navigate the crisis without compromising its financial health. This is a testament to Singapore's robust fiscal policies and disciplined approach to financial management. The pandemic wreaked havoc on economies worldwide, and Singapore was no exception. To stabilise the economy and support businesses and individuals, the Singaporean government had to draw from its reserves. This move was crucial to counter the significant disruptions in economic activities that led to a sharp contraction in Singapore's GDP. Before we delve deeper into how much they have, let's first understand what a foreign reserve is and where Singapore gets it. Foreign reserves are assets held by a country's central bank or monetary authority, usually in various currencies. These assets can include money, bonds, treasury bills, gold, and other financial instruments. They are essential for meeting international financial obligations, such as importing goods, services, and repaying external debt. Foreign reserves also serve as a tool for central banks to ensure stability in their own currency by intervening in foreign exchange markets when necessary. Singapore's foreign reserves are accumulated through various means, such as trade surpluses and the acquisition of US dollars. Thanks to its strong trade sector and prudent fiscal policies, Singapore has built up significant reserves over the years. So, how do these reserves benefit Singapore? Large reserves provide a cushion against external shocks, such as sudden capital outflows or global financial crises. They also instill confidence among international investors and credit rating agencies, contributing to Singapore's economic stability. But it's not just about safeguarding wealth, it's about growing it. Through GIC and Temasek, Singapore ensures that its reserves generate returns that can be used for future generations. This forward-thinking approach is key to Singapore's economic strategy. Singapore's foreign reserves rank among the largest globally, particularly when measured against its GDP. According to the official Sovereign Wealth Fund, GIC Singapore is third in the world in terms of foreign reserves. However, the COVID-19 pandemic brought about a significant challenge, leading to a recent decline in these reserves. So, how does Singapore manage its massive wealth, and why did they have to dip into their reserves during the pandemic? Singapore's foreign reserves are accumulated through various means, primarily trade surpluses and the acquisition of US dollars. Singapore is known for its robust export industry, consistently exporting more than it imports. This results in a net inflow of foreign currencies. For instance, in 2023, Singapore exported a total of $638 billion and only imported $567 billion, maintaining a positive trade surplus from 2019 to 2023. Another source of foreign reserves is through the acquisition of US dollars in exchange for Singaporean dollars. This action helps control the strengthening of the Singapore dollar's exchange rate. Since the early 1980s, the Monetary Authority of Singapore, MAS, has focused its monetary policy on maintaining the exchange rate within a specific target band. The pressure to appreciate the Singapore dollar stems from supply and demand dynamics in fund flows. That's it for today. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section. The fascinating world of gold prices and their potential impact on the US dollar. Gold has always been a significant player in the global economy, but recent trends have sparked some intriguing questions. Is the surge in gold prices killing the US dollar? Let's break it down. First off, let's talk about India. Gold is a massive part of Indian culture and economy. Just like the American dream is to own a home, in India, the dream is to own gold. That's more gold than the central banks of the US, Germany, Italy, France, and Russia combined. For perspective, the US holds around 8,100 tons of gold, while Russia holds 2,332 tons. But Indian consumers alone hold a staggering 21,000 tons of gold. Now, in the past 6 months, if you've been watching the markets, you might have noticed something wild happening. The Indian stock market hit $5 trillion, overtaking Hong Kong. At the same time, gold prices in India reached an all-time high, soaring above 70,000 rupees. While the Sensex returned 8.33% and the Nifty 50 nearly doubled with a 99.92% return, gold prices shot up by an astonishing 16.16%. So why is this happening? One key reason is that central banks around the world are on a gold buying spree. Over the past 2 years, they've been stacking up tons of gold. For instance, India recently moved 100 tons of gold back from England. In recent years, India bought 69 tons, China bought a whopping 314 tons, Poland purchased 130 tons, Singapore grabbed 125 tons, and even the Czech Republic added 75 tons to their reserves. This global trend of gold hoarding has driven prices to unbelievable levels. So, why are central banks loading up on gold? What are the global factors at play, and should you consider investing in gold too? Back in the early 20th century, the world had already endured World War I, and by the late 1930s, World War II was in full swing. The infamous Treaty of Versailles, signed after World War I, set the stage for economic turmoil, which eventually contributed to the outbreak of World War II in 1939. The entire world united against Hitler and his regime, leading to the most devastating conflict in human history. At this time, the British Empire was a global superpower with vast colonies spread across the world. However, the economic toll of World War I and World War II had significantly weakened Britain's wealth. By the early 1940s, Britain's debt to GDP ratio had skyrocketed from 25% in 1914 to 220% in 1920, and further to 270% by 1942. Similar economic distress was seen in other major countries like France and the Soviet Union. Meanwhile, the United States played its cards wisely. Initially, the US stayed out of direct involvement in these wars, acting instead as a supplier of essential goods. America, untouched by the war's destruction, became a prosperous land of plenty. Cheap fuel and technological advancements powered a booming economy. American industry was perfectly positioned to dominate both domestic and global markets after the war. Here's where it gets interesting. While other empires were fully engaged in the war, diverting all their resources to the battlefield, the United States focused its capital and manpower on becoming a major supplier. They provided cotton, wheat, brass, rubber, automobiles, machinery, and thousands of other goods to the war-torn countries. This strategy led to one of the greatest economic booms in US history. US exports skyrocketed from $2.4 billion in 1913 to $6.2 billion in 1917. In the 1940s, the world had already experienced the devastation of World War I and was in the midst of World War II. The infamous Treaty of Versailles, which ended WW1, had set the stage for economic turmoil, eventually contributing to the outbreak of WW2 in 1939. By profiting from these costly wars, the US accumulated vast wealth. While other economies lay in ruins, the United States ended up holding 75% of the world's monetary gold. US gold reserves surged from around 2,000 tons in 1910 to nearly 20,000 tons by 1940. This unprecedented wealth set the stage for the United States to solidify its economic dominance. In 1944, the US convened a conference in Bretton Woods, New Hampshire, gathering representatives from 44 allied nations. The goal was to establish a new international financial order and promote economic cooperation post-war. This meeting resulted in the Bretton Woods Agreement. Under the Bretton Woods Agreement, these 44 countries agreed to peg their currencies to the US dollar, which was in turn pegged to gold. This arrangement meant that 1 ounce of gold was worth $35, or 28.35 grams of gold equaled $35. The US promised to redeem dollars for gold, effectively backing the dollar with gold. This gave countries confidence in holding US dollars, knowing they could exchange them for gold. So, why did these countries agree to the Bretton Woods Agreement? The main benefit was stability. By pegging their currencies to the US dollar, countries gained a reliable exchange rate system, which facilitated international trade and investment. Additionally, backing the dollar with gold provided a sense of security, as gold was universally recognized as a valuable and stable asset. This system helped the US dollar become the dominant global currency, underpinning international financial stability for decades. The Bretton Woods Agreement laid the foundation for the modern global economy, with the US at its center. The Saudis were not wealthy in the early 1940s because their oil production was just beginning. During World War II, Italy bombed Saudi Arabia, targeting American oil facilities, which hampered the Saudis' ability to produce oil at full capacity. In desperate need of protection, Saudi Arabia sought help from the United States. In 1945, US President Franklin Roosevelt recognized the immense global importance of oil for the coming decades. He held a crucial meeting with the King of Saudi Arabia, resulting in a pivotal deal. The United States agreed to protect Saudi Arabia from future attacks and supply them with military equipment. In return, the Saudi king agreed to sell oil primarily in US dollars. This deal significantly boosted the rise of the Middle East and cemented the US dollar's role as the dominant global currency. By the 1960s, when oil-producing countries formed OPEC, all member nations started selling oil in dollars. However, recent geopolitical events and economic practices have led to a gradual decline in confidence in the US dollar. During the Russia-Ukraine war, the US froze $300 billion of Russian assets and $7 billion of Afghan assets after the Taliban took over. This move alarmed countries like China, which feared similar actions against their $797 billion in US Treasury bonds. As a result, China and other countries started buying large amounts of gold as a hedge against the potential devaluation of their dollar reserves. The US's frequent money printing has also contributed to the declining confidence in the dollar. For example, the US printed nearly $1 trillion during the 2008 recession, $4 trillion in 2020, and about $2 trillion in 2021. This excessive money printing leads to global inflation and reduces the value of the US dollar. Consequently, countries with significant dollar reserves, like China, see their reserves value diminish. Gold, being a finite and non-printable resource, retains its value, making it an attractive option for countries looking to preserve their wealth. The limited availability of gold, enough to fit in a 23-meter cube, ensures its value remains stable. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comment section. A land where economic history reads like a suspense novel, the Netherlands. You might think of tulips and windmills, but there's so much more beneath the surface of this small but mighty nation. The Dutch didn't just stumble into modern economics, they practically wrote the first chapters. Picture this. Centuries ago, they were already mastering international trade, setting up corporations, and yes, even pioneering financial markets. But it wasn't all smooth sailing. They've seen boom and bust cycles so wild, it makes today's stock market swings look like a mild roller coaster ride. Fast forward to now, and the Netherlands isn't just keeping up, it's leading the pack in productivity. Think of it as the productivity champ of Europe, rubbing shoulders with economic heavyweights like the USA. But here's the kicker. They've managed to achieve this while still prioritizing quality of life. Imagine a country where part-time work isn't just common, it's the norm. Thanks to a culture that values a well-rounded life over workaholic tendencies, the Dutch have nailed the art of balancing output with happiness. And let's talk resources. The Netherlands sits on a gold mine of natural gas, enough to make any economy drool. But here's where it gets interesting. They've chosen to leave a significant chunk of it untapped. Why? Environmental concerns and a little thing called Dutch disease, where reliance on one industry can backfire spectacularly. Speaking of which, their history reads like a cautionary tale for other economies. They've learned the hard way not to put all their eggs in one economic basket. It's a lesson in diversification that many could stand to learn from. So, how did they pull it off? It's a mix of foresight, adaptability, and a knack for balancing risk and reward. The Dutch aren't just thinking about tomorrow, they're paving the way for it, all while ensuring today is pretty darn good. In a world where economic success often comes at the expense of well-being, the Netherlands stands out as a beacon of how things can be done differently. It's not just about GDP numbers here, it's about human development indices that soar and a society that values progress without leaving anyone behind. So, why does the Netherlands do things so differently from other wealthy nations? And should their model be a blueprint for others to follow? The Dutch approach is a tale of pragmatism and foresight. They've long understood that economic success isn't just about raw output. It's about quality of life and sustainability. Unlike some economies fixated on relentless growth, the Netherlands prioritizes balance. They've mastered the art of fostering a productive workforce while ensuring people have time to enjoy life, a model where part-time work isn't a compromise but a choice. And should other major economies follow suit? Well, the Dutch model offers a compelling case. It's a testament to how a strong financial sector can fuel growth without sacrificing stability. Amsterdam's historic stock exchange isn't just a relic, it's a testament to their commitment to long-term investment and economic resilience. So, should we put the Netherlands on the Economics Explained leaderboard? Absolutely. Their blend of economic prowess, societal balance, and historical resilience makes them a standout example in today's global landscape. Whether it's their commitment to sustainable growth or their innovative financial strategies, the Dutch model offers lessons that transcend borders. In a world where economic paradigms are constantly evolving, the Netherlands stands as a testament to what's possible when innovation meets prudence. So, whether you're an investor looking for opportunities or simply curious about the forces shaping our economies, keep an eye on the Dutch. They're rewriting the rulebook, one tulip at a time. At its peak, the Dutch merchant fleet was a behemoth, dominating European shipping with a capacity that rivaled half of the continent's total. The Dutch East India Company in particular stands as a pioneer of multinational enterprise, but let's put things in perspective. Claims of its astronomical value, like a $7 trillion market cap in today's terms, are often exaggerated. To contextualize, that would be like Apple today having a market cap of $700 trillion. Unthinkable. The wealth of the 17th century was a drop in the ocean compared to today's global economy. Adjusting historical figures to modern standards is fraught with challenges, and other companies of the time, like the Mississippi Company, had higher market valuations, albeit under dubious circumstances. But beyond the history lesson, these early Dutch ventures laid the groundwork for modern economic strategies. Despite setbacks, including French occupation and the loss of Belgium, the Netherlands adapted. By the 19th century, they embraced industrialization and leveraged a business-friendly environment to regain footing. Fast forward to the aftermath of World War II, and another twist, the discovery of vast natural gas reserves. It seemed like a windfall, a boon for an energy-hungry Europe. However, this discovery wasn't without its downsides. Enter Dutch disease, a term coined when a sudden resource boom disrupts a nation's economy, leading to over-reliance and neglect of other sectors. The Netherlands faced a dilemma: how to harness newfound wealth without succumbing to economic imbalance. Their solution? Strategic investment in infrastructure and technology, ensuring that prosperity was shared across society. It's a lesson in managing abundance responsibly, a balancing act between short-term gains and long-term sustainability. Dutch disease, a phenomenon where a sudden resource boom can disrupt an economy, is a cautionary tale. Yet, the Netherlands managed it better than most, leveraging their existing wealth to mitigate its impacts. They taxed short-term gains from natural resources to fund long-term investments in diverse industries, a strategy that's harder to implement in poorer countries where immediate gains could drastically improve quality of life. Today, the Netherlands shines as an economic powerhouse, driven by a diverse range of high-value industries. Its allure for global businesses is undeniable, offering a business-friendly environment coupled with a robust legal system and a multilingual workforce. This combination has made it a strategic hub for international operations within the European Union. But what truly sets the Netherlands apart isn't just its economic prowess. It's their unique blend of business acumen and egalitarian values. Part-time work isn't a compromise here. It's a choice supported by legislation that promotes work-life balance without penalizing career progression. This approach has elevated labour force participation rates, even surpassing the workaholic culture of the USA, all while maintaining a generous social safety net. Moreover, the Netherlands proves that economic success doesn't require overworking its people. Instead, it champions a balanced approach that values both productivity and well-being, a luxury few economies afford. Now, while the Dutch model may not be easily replicated elsewhere due to unique historical advantages and infrastructure, it offers valuable insights. It shows how strategic investments, prudent economic policies, and a supportive regulatory framework can foster long-term prosperity. The Netherlands may be small in land mass and population, but with a GDP of over $1.1 trillion, it's the 17th largest economy globally. Given its size and output, the Dutch economy scores an impressive 8 out of 10. However, growth has been lackluster. Despite resilience, the country struggled through the Eurozone crisis and subsequent slowdowns. Recent trends are positive, but with sluggish growth averaging around 1% annually over the past decade, it scores a 3 out of 10 in this category. The Netherlands has successfully diversified beyond natural resources to tourism, finance, trade, and high-yield agriculture. This resilience earns it an 8 out of 10, noting its smaller footprint in global corporate giants. With an average score of 7.6 out of 10, the Netherlands secures a strong position on the Economics Explained leaderboard. Its blend of productivity, stability, and strategic industry focus showcases a model that balances tradition with innovation. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comment section.